Gold and silver has just seen one of the steepest price declines in recent history, with silver prices plunging sharply and gold breaking its rally momentum. This happened after record runs, and now traders are asking, why did it crash? Is this manipulation or markets rebalancing? And what happens next? Today we break down the real reasons behind this move, the macro forces driving price action, technical influences, and what analysts are watching for 2026. Before we dive into the breakdown, let's remember how we got here. In 2025, gold and silver surged dramatically, fueled by inflation fears, geopolitical tensions, and safe haven demand. Precious metals hit record highs as investors sought protection from currency weakness and systemic risk. Silver in particular saw an explosive rise due to its dual role, monetary hedge and industrial metal for solar, electronics, EVs and green energy applications, creating structural pressure. This set the stage for high valuation levels right before correction pressure built. What triggered the plunge? Let's break down the core drivers of the recent downturn. Number 1. Fed policy and dollar strength. One of the clearest catalysts was the reaction to US monetary policy clarity. When President Trump nominated Kevin Warsh as Fed chair, markets interpreted this as signaling the Fed's independence and a higher for longer policy stance. That boosted the US dollar, which historically pressures gold and silver since they're priced in US dollars. A stronger dollar and expectations of fewer or delayed rate cuts undermine the safe haven bid that has been supporting metals. Number 2. Profit taking after extreme moves. Both metals had rallied far beyond historical norms. When prices get overbought, it often triggers profit taking and technical selling, traders booking gains after rapid advances. Number 3. Liquidity and forced positions. In rapidly rising markets, leverage builds as prices turned. Leverage positions were hit with margin calls and forced liquidations, adding downward pressure and creating cascade effects. Number 4. Circuit limits and ETF selling. On some exchanges, gold and silver futures hit lower circuit limits, forcing pragmatic sell events, especially on days with high volatility like budget announcements or macro news days. Manipulation versus market mechanics. There's been talk online about manipulation. Let's unpack that. Paper versus physical price discrepancy. Many traders online point to the divergence between paper contracts, futures, CFDs, and the physical market. When futures get volatile, automatic margin hikes and risk controls can force selling. Not necessarily a deliberate manipulation, but a built-in feature of how leveraged derivatives work. Is there systemic suppression? While sudden moves can look coordinated, most analysts attribute the crash to market structure, leverage and risk repricing rather than a single entity pushing prices. Commodity markets can amplify moves when positions are crowded, especially after parabolic rallies. The bottom line, the price action is genuine market dynamics, reacting to cash flows, risk shifts, and macro triggers, not necessarily intentional market control. Why silver often falls harder? Silver tends to be more volatile than gold, and there are reasons. Industrial demand. Silver is both monetary and industrial. When uncertainty eases slightly, industrial demand downturn pressure can weigh more heavily on price. Leverage and margin sensitivity. Silver markets often have higher leverage, meaning forced liquidations can cause sharper moves. Supply and demand imbalances. Despite volatility, silver has persistent supply deficits and tight inventory at major vaults, supporting a longer-term bullish structure even amid corrections. Macro drivers still supporting metals. Despite the recent downturn, several macro factors still support higher prices in the medium and long term. Central bank buying. Major central banks have been increasing gold reserves, diversifying away from pure fiat exposure. Safe haven demand. Geopolitical tensions, trade wars, sanctions, war risks keep safe haven demand elevated. Industrial and structural silver demand. Demand from green energy, solar, EVs maintains a solid long term case for silver, even if short term prices swing. Analysts still forecast moderate gains for gold and silver by the end of 2026, with gold possibly rising another 8 to 15% and silver 20 to 35% from current levels if macro uncertainty persists. Risks that could keep prices lower. Not all signals are bullish. There are significant headwinds too. Strong dollar and rate expectations. If the US economy surprises on strength and inflation, moderates without deeper rate cuts, real yields could rise and reduce safe haven demand. Reduced risk premium. Some analysts like Citi think part of the geopolitical and macro risk premium baked into prices may fade later in 2026, which could cap upside or keep prices suppressed. Where prices could go next. Let's explore scenarios. Bullish scenario. If geopolitical risk intensifies, the Fed signals cuts, real yields fall, and dollar weakness continues. Gold could reclaim momentum and potentially target higher levels over time. Bearish consolidation scenario. If macro uncertainty lessens, rate cuts are delayed, and the dollar strengthens, metals could remain volatile and consolidate at lower levels before finding support. The best outcomes often come when volatility tempers and fundamentals reassert themselves. Conclusion. So in summary, the crash was real, driven by macro shifts, profit taking, leverage and risk repricing. It wasn't a random move, but a market adjusting from extraordinary extremes. Long-term fundamentals are still in place for precious metals, but volatility remains high. Comment below, reset or rally? Where do you think gold and silver go next?